Hello and welcome to the Charter Hall Direct Insight series. I'm Julian Menegazzo and I'm the Fund Manager of the Direct business here at Charter Hall. I would like to begin today by acknowledging the traditional custodians on the land at which we gather today and pay my respects to their elders past, present and emerging. I would also like to thank you all for joining me for an update on Charter Hall and our Direct suite of funds for the March 2023 quarter. Well, the start of 2023 has brought with it a number of economic challenges that we are navigating through, including the continued aggressive rise of the cash rate by the RBA to 3.85%, heightened inflation tracking at around 7%, and other geopolitical issues that continue to play out across various parts of the globe. Despite these challenges, our strategy here remains focused on creating value and generating superior returns for our investors over the medium to long term. During the quarter, Charter Hall issued a white paper titled Why Australia? This paper highlights Australia's relative global resilience and real estate outperformance over many decades. In times of uncertainty, it's critical to keep things in perspective, and this paper benchmarks Australia against other global peers on a quantitative and qualitative basis over the past decades, looking through past economic cycles. I will provide a summary of the key findings a bit later in today's presentation. At Charter Hall, we remain focused on executing our investment strategy around portfolio curation and active property management, and I will provide details on some of the key transaction and leasing details executed over the quarter also a bit later in the presentation. Today, I will be joined by our guest speaker, Fiona Dennison. Fiona is the Head of Asset Management across Charter Hall's $30 billion office portfolio. The office sector has been the topic of many media headlines recently. Fiona will provide some highlights and insights into how well our portfolio is positioned in terms of occupancy and lease expiry, key trends that we are seeing across the sector, and what we are doing differently as a management team here at Charter Hall to best position our portfolio. Before I begin, there will be a Q&A at the end of today's presentation where I'll be answering a number of pre-submitted questions, and if you have joined us before, you will know there is no live Q&A. However, if you have any questions, please include your preferred means of contact, like your phone number or email, and someone from the team will get back to you. I'd like to remind you that we are not in a position to provide financial advice. Today's information is an update on our funds and the market more generally. If you have any queries that relate to your own personal investment situation, we always encourage you to consult your financial advisor and read the product disclosure statement or information memorandum in full. Today's agenda will follow a similar pattern to previous quarterly updates, being a short overview of the Charter Hall Group. I will run through how the funds are performing that many of you are invested in. I will also provide an overview of the Why Australia white paper and global perspectives on the Australian real estate market. You will hear from Fiona Dennison, Charter Hall's Head of Asset Management across the office sector, and I will finish up with a direct fund update. The first slide in today's presentation outlines the size and scale of the Charter Hall platform. Charter Hall now manages $88 billion in funds under management and is the largest owner of real estate across Australia, covering the core property sectors of office, industrial and logistics, long WALE retail, convenience retail and social infrastructure, comprising a real estate portfolio of over 1,600 properties. As you can see on the pie chart on the right, this outlines the different investment allocations across the various sectors comprising of the $88 billion, with industrial and logistics and the office sector comprising over 60% of our real estate portfolio. At Charter Hall, we remain disciplined in our investment approach, focusing on well-located properties with strong tenant covenants and long-term leases that provide fixed annual rent reviews across each investment. I will now provide details on the Charter Hall Direct business that many of you are invested across in the funds that we offer. Across Direct, we have a portfolio comprising of $11 billion invested in 130 directly owned properties across the Australian market. The underlying fundamentals of the portfolio are well positioned, maintaining an occupancy level above 99%. In fact, we have maintained high occupancy across all our direct funds over a long period of time. This is a key focus for the management team. The funds also provide access to a weighted average lease expiry profile of 7.9 years, underpinned by a diverse range of over 450 tenant customers across the direct portfolio, providing security of income over a long period of time. Moving into the respective funds' performance, this slide, now on screen, provides an overview of the performance of the open funds over the 12-month period to March 2023. 3 of the 4 funds, being LWF, DIF4 and DOF, highlighted in blue, performed above the 12 months benchmark, highlighted in grey. The benchmark we use is the MSCI Wholesale Funds benchmark here at Charter Hall, as this compares our funds to other high-quality institutional grade property. As we have highlighted many times on these presentations, unlisted real estate should be considered a medium to long-term investment. The highest performing fund was LWF, being 7.4%. Unfortunately, the office funds of DOF and PFA performed slightly lower at 4.3% and 2.6% respectively over the same period. I will touch on the performance and relative benchmark in more detail with a question that was submitted in the Q&A. As part of the regular valuation process, the entire suite of properties in the Charter Hall Direct Funds will have independent valuations performed in the upcoming June 2023 quarter. Whilst short-term performance is important, property should be considered as a medium to long-term investment or 5-year plus investment term. So, how have these funds performed since they were launched over the medium to long term? Well, I'm pleased to report that the funds across the direct business continue to exceed the benchmark across their respective fund launch dates or since inception dates. As you can see from the blue bars on this chart, the returns outlined per annum comprise of distributions and movements in the value of the unit price. The reason that the benchmark varies between funds is because it depends on when the respective fund was launched. Irrespective of this, you can see on screen that all the direct funds have significantly outperformed over a long period of time, which is an outstanding result for our investors. The team here at Charter Hall are very proud to have achieved this performance for investors since each of these products were launched over a long period of time. This slide up on screen shows the return of our funds that are closed for investment. These funds have all performed strongly from their inception periods, outlined in the blue bars, versus the benchmark highlighted in grey. The fixed life funds do tend to have gearing ranges a little bit higher than our open funds, which have elevated their respective performance over time when compared to the open-ended funds. Irrespective of this, all the direct funds have materially outperformed its respective benchmark since inception. Moving now for what this means for each of the underlying funds' unit price. You can see these up on screen, the fund's unit price as at 31 March. You will note some small decreases over the quarter. This is primarily due to the way costs are amortised, including stamp duty, due diligence and legal costs when assets are acquired. We accrue these into the unit price and amortise these costs over the 5 years. The way in which we manage our funds at Charter Hall, each portfolio is independently valued at 30 June and 31 December. And during the 6-month period, you will tend to see the unit price come off slightly as these costs are amortised. The major valuation movements for our funds occur at the independent valuation dates on 30 June and 31 December. So more details on this will be provided over the next quarter. We have also highlighted on the right the type of investment, noting that they are all illiquid investments except for the Maxim Property Securities Fund. During the quarter, Charter Hall issued a white paper titled Why Australia? This paper explores the factors that support Australia's relative global resilience and real estate outperformance over many decades. As Australia's largest owner of real estate, we are often asked by our offshore investors, why is Australia so different to other global investment destinations? This slide provides an overview of why Australia is relatively well positioned for resilient growth moving forward and is a preferred choice for investment, including our access to natural resources. Australia has one of the largest diversified natural resource reserves in the world, with $379 billion of resource and energy exports in financial year 2022. We are also a global leader across ESG. Australia is transitioning towards becoming a renewable energy global leader with a commitment to renewable energy and large solar projects. From a property perspective, ESG continues to gain momentum across the industry, with 17 out of the 24 Charter Hall funds scoring in the top quartile across the leading global real estate sustainability benchmark survey. Australia has also achieved a record 29-year period without a recession. This has now continued in a post-pandemic environment, with forward growth forecasts to outpace the major other global economies. Australia also holds a AAA credit rating and has one of the lowest debt to GDP ratios in the world. We also have over $288 billion of infrastructure projects currently under construction. This helps support the economy, creating jobs and supporting population growth. Overall, despite the current challenging economic backdrop around interest rates, inflation and other external factors, Australia is relatively well positioned against its peers. Australia has a resilient economy, and this is anticipated to continue, benefiting from a diverse economy and return of population growth. We are considered a global safe haven with high levels of transparency, making the Australian real estate market an attractive destination for investment. As I mentioned earlier, Australia is also emerging as a global leader in ESG. Australia has a long track record of outperforming risk-adjusted returns across the Australian real estate market. These are just some of the key factors driving global capital demand for our country across commercial real estate. We expect the sustained global interest will provide relative price stability and support the future growth of Australia's major real estate sectors over the long term. Please reach out to one of the Charter Hall team members if you would like a copy of the Outlook paper that we recently issued. I am pleased to now be joined by Fiona Dennison, Head of Asset Management for Office here at Charter Hall. Fiona has over 30 years' experience in the Australian property industry across office and retail. Fiona is responsible for leading a team focusing on value creation and income risk mitigation across Charter Hall's $30 billion Australian office portfolio. This includes managing the internal and external asset, property, operations and finance management to ensure delivery of thriving tenant customer communities. Well, I'm now joined by Fiona Dennison, Head of Asset Management across the office sector here at Charter Hall. Welcome, Fiona.
Thanks, John.
Well, Fiona, the office sector has been certainly in the headlines more recently. As one of the largest office owners across the country, we have exposure to some of the best assets in the market. First question I'd like to ask you today is, what are we seeing on the ground across the Charter Hall office portfolio?
Great question, thank you. Thanks for having me today. I think at Charter Hall, as you say, we do have the biggest footprint in Australia in terms of commercial office buildings. We have 2.5 million, or over 2.5 million square metres, and roughly 900 tenant customers, or as we call them, customers. So because of the breadth of the portfolio and the scale of assets being 113 around the country, we have a deep amount of insights as to what is going on in the office sector at the moment. Headlines are one thing, but what we're seeing on the ground is certainly a different story. We have roughly, well, in the funds, we have 98 to 99% of the funds occupied. At the moment, we are seeing retention rates in the high 80%, meaning, you know, when we talk to tenants, they stay. They like being in our buildings. We have average lease, or WALEs as we call them, of circa 7 years across this portfolio. So I'm happy to say that at Charter Hall we've got a really high performing, high regarded and highly occupied portfolio.
That's great, Fiona. There's some really positive numbers coming out across our office portfolio. What are the key trends that you're seeing that tenant customers are looking for at the moment?
Sure, and I think COVID has had a little bit to do with accelerating trends that we were seeing well before COVID. And I'd say the key trends that we're seeing are around ESG, or sustainability, as we would call it. The E being the environmental sustainability, so making sure people want to know that they are in carbon neutral precincts, or they are in precincts that are moving towards carbon neutrality. What we know is that people, whether it's the recycled coffee cup that you use on the weekend or the office building that you come to, they all have to have a very strong purpose, very important. So that trend in environmental sustainability has been here for quite some time in office. The S of the E, S and G is social sustainability, and that's something that is ever increasing in our world. And again, that comes back to purpose. People want to know that when they come to their office that there is a social element. What does my work, what does my building, what does this footprint give back to society? And it's a small example of that. We operate our assets in such a way that we know we support, say, women coming out of a domestic violence situation by using an organisation called Too Good to provide all the hand soaps in all of our buildings. Just one small example, but purpose and being somewhere that cares about society is more important to the customers in our buildings and the consumers, their workforce. And if they're not doing these things, then people don't want to come into that environment and work for those people. As we know, the fight for talent is quite huge at the moment. So, and then the G of the E, S and the G stands for governance. And governance is, it's kind of what we do every day. We look after somebody else's money every day, and we have to do it with the highest principles in mind. So every day, that is an absolute part of who we are and what we do and what our tenant customers are expecting. Other than E, S and G, the other key themes are really, I would say, flexibility. But flexibility doesn't mean I want a 3-year lease term or a 5-year lease term. Flexibility means the ability to flex around the building and use space differently over time. So it means everything from, say for instance at our head office at number 1 Martin Place, having a beautiful cafe environment that people can go to for free and use high-speed Wi-Fi to be able to do their jobs and interact with their colleagues in that space, all the way through to flexible business hub spaces and up to their desk. So from street to seat has never been more important, and everything in between. So that's what flexibility means these days, flexibility of use of space. And another key theme is, what's the purpose of the office? That is a theme that has definitely accelerated through COVID. People can choose. They can choose to work from home now. We did work from home before COVID, but now, you know, we were forced to work from home for quite some time, so people are quite used to working from home now. But why am I going to come into the office? What is the purpose of the office? So our tenant customers are asking us to help them redefine the purpose of the office, which is a big theme for us at the moment.
No, there's some really interesting themes starting to play out. And one of the things we touched on earlier in the presentation today is around this flight to quality. Yeah. Is that something that you can give our investors some insights of what we're seeing in terms of flight to quality?
So I might throw out some statistics if that's okay. We, in the last 9 months at Charter Hall, we've done just over 316,000 square metres of leasing. So to put that into context, that's number 1 Martin Place times 10. That's how much leasing we've done in 9 months. And as part of that leasing, we talk to those tenant customers about why are they staying, why are they coming, what are their key drivers. We try and with 2.5 million square metres, we get a great depth of analytics out of the conversations that we're having. So we know that roughly 48% of people that we've done those 315,000 square metre deals with, roughly 48% is a flight to quality. But flight to quality means it might be a better building in some instances, or it might mean there's much more amenity, which is what people are determining as flight to quality, because you don't want to necessarily come back to a building that doesn't have a richness of amenity at the bottom of it, whether again it's a good high-speed Wi-Fi enabled cafe or a food court close by or a shopping centre close by. So people want to come back and move to office buildings that have that quality of amenity around them. We've also seen, interestingly, out of those lease deals that I was talking about, unfortunately, the press likes to tell us that people are getting rid of space and no one's taking the same amount of space anymore. Out of those deals that we've done in the last 9 months, I can tell you we have one deal where somebody has shrunk. The other deals that we've done, they have all taken the same amount of space or they have expanded in their footprint. And the one transaction where they did take less space was because they were consolidating from 5 locations down to 1. So we are not seeing a shedding of space across the portfolio. And because we are doing a lot of work and have a lot of customers, we do feel that our insights are really quite deep.
And partnering with our tenant customers is something we take very passionately and seriously at Charter Hall. It'd be great to get some insights from you, some examples of how we are partnering with our tenant customers and how we approach our tenant customers on a day-to-day basis.
Absolutely. And I have to say I've been in the industry for a few decades now, here at Charter Hall for about 15, 16 months, and the deep way that we talk about customer and we act around our partnerships with our customers, it is embedded in this organisation from the absolute top throughout the whole organisation. As you know, we live and breathe it on a daily basis. We are so motivated by making sure that we understand what our tenant customers need, because that partnership is going to hold them and ourselves in good stead through good times and bad. We know from time to time partners will need, or customers will need, more space, and we need to help them find it, but sometimes they need less space as well. And if they do, because there might have been merger and acquisition activity or other things like that, we want them to know they can come to us, and we are a solutions-based organisation that is absolutely grounded in partnership. So come to us. We mightn't have the answer straight away, but we will find the answer together. So we have some fantastic examples. I mentioned before the purpose of the office, and that is something universally, whether it's the landlord or the tenant customer, universally we are all trying to work out the purpose of the office. We have deep relationships with major Australian corporates, banks, corporates. We get them together, not industry competitors, but we get our tenant customers together, and it might be the head of workplace or the head of human resources or people and culture. We get them together, we walk them around each other's workplaces, we have workshops, and we help them intersect with their peers to be able to work these things out together, because nobody has the complete answer of how the post-COVID office looks like. But we all know we need to do more about collaboration space. So having these deep relationships means we can help them lean into each other, and we solve the problem together. We're all richer for that at the end of the day.
No, great, thank you. And challenges, obviously we've spoken a lot about the positives in office. Where do you see some challenges that we face over the next 12, 18, 24 months?
Yeah, sure, and that, we know that economic conditions are a little bit different today than what they were, say, 12 months ago. Again, having been around for a little while, I've seen a few different cycles in office. I think the challenge now is, and it does come back to that purpose of the office piece. We know that more than ever, we used to have a landlord-tenant relationship. It's not like that anymore. It's a partnership. We know that we speak to our tenant customers and they want us to help them use the office and everything about the office, the amenity, the street presence and so forth, help us get our people back into the office, help us regain the productivities that perhaps we've lost through COVID, help us redefine what the purpose of the office is. So those partnerships are more important than they ever were, because they need us to do things like activating, having functions, having activations, using multi-purpose areas to have yoga or Pilates classes, or the free flu shot day, or mental wellbeing workshops, or things that make people want to come into the office and be together and collaborate. So I feel that if an asset, if a building fails to have those types of amenities, that's where we're going to see some disruption in the market going forward. So we have to make sure that our assets remain very relevant and have those amenity pieces within them or very close by, because there will become some assets that might be stranded in the market if they're not offering those types of amenities. Corporates won't take space because they're not helping the corporate enable getting people back into their workplaces. So that's where I think there could be some disruption, that some assets will become obsolete or stranded perhaps in the future. But thankfully I think we've got the team to we know we need to address it if we have assets like that, and we have the team to be able to address that.
Well, it comes back to that ongoing flight to quality and also ongoing capital investment in the assets as well, which obviously at Charter Hall we do invest in our assets to make sure we differentiate ourselves.
Absolutely.
I guess my final question I've got for you, Charter Hall, $30 billion office portfolio, one of the largest office landlords in the country. What do we do differently to our peers?
Yeah, sure. This is a very easy one for me to answer quite authentically, because it's why I wanted to be here. And it is around customer. I would say there's two key things that we do very differently to our market peers. One is how deeply we are invested in the partnerships with our customers. It is unlike anywhere I have ever seen in my career. Again, from from our CEO and Managing Director throughout the business. It is an absolute key theme across sector, whether that's office, industrial, retail or others. We are all deeply embedded in customer. But I also think that because Charter Hall was somewhat ahead of the wave of what office needed to evolve into pre-COVID, because most of these themes were around pre-COVID, our CEO of the office business, Carmel Hourigan, said about putting together a team of specialists that could enable us to be the best in the business in the elements that we need to be really good in: partnership, customer, flexible spaces, ESG, all the things that I've spoken about today. We have fundamentally gone about collecting the best people in the market, putting them inside this business to ensure that we are pointing exactly at what the customers need. We listen, we're very, very good listeners. We ask too, what is it that you need? And we listen, and we've enabled a team of absolute subject matter experts to point right at that. So that's what I think is our primary point of difference.
Great. Some really good insights, Fiona, and it sounds like the team's extremely busy and working extremely hard across the entire Charter Hall office portfolio, including the office funds that I look after in direct across DOF and PFA. Thanks for your time, Fiona. It's been really beneficial for you to give us some insights across what's happening and what we're seeing on the ground. And it sounds as though the office sector's in pretty good shape the way we see it.
I think so too.
Great.
Thank you, Julian.
Thanks, Fiona.
Thank you.
Across our funds here at Charter Hall, we regularly assess properties on their strategic value in the context of the fund's investment and capital management strategy. At times, properties may be identified as non-core for a number of reasons, including their performance outlook, where we believe value has been maximised, asset size relative to the portfolio, asset age, and the future assessed risk profile. Over the past 6 months, in a challenging capital markets environment, we have successfully completed over $100 million in asset sales across PFA, DIF4 and LWF. The largest transaction was the sale of a 49% interest of Westmead IQ that was sold for $66.9 million, in line with the fund's book valuation. Proceeds from the sale were utilised to fund the first redemption tranche payment from the fund's major liquidity event. Pleasingly, the balance of all assets were sold in line or at premium to book value. Investors should be aware that selling assets at this level is not always possible, particularly in the current environment, so these transactions are a great result for investors. Another key focus for the asset management team here at Charter Hall is maintaining the high occupancy rate, currently sitting at 99%, and achieving strong market rental growth across the portfolio. A combination of these factors helps support valuation growth over the long term. As you can see on the screen, this summarises a number of key leasing deals achieved over the quarter, with over 16,100 square metres in leasing completed. These deals range from 3 to 6 years across both government and corporate tenant customers. It is worth highlighting that across the open funds of DOF, PFA, DIF4 and LWF, the major tenant customer is the government, comprising a combination of both federal and state government depending on the fund. Staying on the office sector, this slide outlines the strong occupancy position across both DOF and PFA versus the broader market occupancy rate. This shows the percentage of the office portfolio that is occupied and generating income for our investors across our two funds. Our direct office fund is 98% occupied and the direct PFA fund is 99% occupied. This is well above the market average of 85%, and this trend has been a consistent theme over our historical occupancy levels. This shows the focus of our investment management team has on managing our assets, ensuring high occupancy levels across the respective portfolios. As Fiona touched on earlier, one of the key themes we are seeing across the office sector is tenant demand for high quality office accommodation in core office markets. This slide outlines the change in occupied stock over the last 24 months to December 2022, with over 700,000 square metres gravitating towards prime grade or higher quality office space, while secondary lesser quality office space was negative over 130,000 square metres over the same period. The bifurcation between prime and secondary office grade assets will continue moving forward. with tenants seeking high-quality office assets to provide their employees with good amenity, health and wellness attributes, as well as high-quality sustainability credentials. Both DOF and PFA are well positioned and have a high portion of the portfolios weighted to prime office space. Before moving into the fund updates, I would like to share a video with you on 60 King William Street, one of PFA's office assets currently under development that is approaching completion later this year. 60 King William Street is a landmark development located in the Adelaide office market. The 43,000 square metre prime grade office asset includes a 15-storey office tower with state-of-the-art facilities and ground floor retail. The tower is pleasingly 94% pre-committed, leased to high-quality tenant customers being the Australian Government, NAB and Telstra. Targeting a 6-star Green Star and 5-star NABERS energy rating on completion, the building will be enabled for zero net emissions in operations, integrating an all-electric mechanical central plant, and will be powered by 100% renewable energy. I hope you enjoy this short video on the time lapse since construction commenced in early 2021. This now brings me to the update across the direct suite of funds, including the funds that are open for investment and the fixed life funds. The first fund I will cover today is the Charter Hall Direct PFA Fund. The fund benefits from a very high occupancy rate of 99% and has a portfolio value of over $2.45 billion of office assets spread across the Australian office sector, with over 75% exposure to the eastern seaboard office markets, and provides investors to a long weighted average lease expiry profile of 6.2 years. The PFA fund is open for investment and is focused on properties leased to state and federal government. These government rental streams account for over 60% of the fund's net operating income. The fund has continued to perform strongly, generating 9.7% total return since inception, and benefits from a strong environmental rating and pays distributions on a monthly basis. Management continued to work through the capital management strategy for PFA, paying 25% of the total redemption requests during the March quarter. We have identified and are working through a number of assets identified for divestment to enable the delivery of the liquidity through 2023. Having regard to the current challenging economic conditions, this is impacting sales across the broader property sector. Management is committed to delivering liquidity to those investors who elected to redeem. As further asset sales are finalised, redemption requests are expected to continue to be satisfied on a pro rata basis. Moving now to the Direct Office Fund, which is also open for investment. DOF is a $3.23 billion office fund, and its investment strategy focuses on core CBD established Australian office markets, with 94% of the portfolio weighted to the eastern seaboard. The fund's top 5 tenants comprise of close to 60% of the fund's overall income, benefiting from over 30% of income generated from federal and state government tenants, as well as exposure to other important tenant customers like the Western Sydney University, Coles, Suncorp and Westpac. The fund benefits from a high occupancy rate of 98% and a weighted average lease expiry profile of 6.4 years. The fund continues to perform strongly, generating 13.6% return since inception and pays distributions on a quarterly basis. Moving across to the industrial and logistics sector, and the strong market fundamentals continue to play out. You can see on this slide how well Australia is positioned across the industrial and logistics market globally. We now have the lowest vacancy rate across the globe at 0.6% at a national level. This is expected to continue to remain at this level until further stock is completed across the sector. Low vacancy and limited land supply is continuing to drive strong rental growth across the industrial and logistics sector. Over the 12 months to March, the national rental growth is now at 22%. The rental growth story is expected to continue, being driven by continued strong market fundamentals, including low vacancy, shortage of development land, and leasing demand across sectors including e-commerce, health, and consumer staples. I would now like to show you a short video on one of Div4's high-quality industrial assets located in Symonston, Canberra. Div4 has a 50% interest in the asset. Given the scientific nature of the tenant, the property comprises a specialised life science complex of over 32,500 square metres of gross lettable area. The property is fully leased to Geoscience Australia, a Commonwealth Government agency, and provides a lease expiry profile of 9.2 years. I hope you enjoyed this short video. The Charter Hall Direct Industrial Fund Number 4, or Div4, is now a $3.5 billion fund in size. It has 100% occupancy and provides a 10.3-year weighted average lease expiry profile. The tenants across the industrial and logistics centre tend to be larger than the other sectors, spread across more assets. You can see on the screen the quality of the tenant customers, with the top 5 tenants comprising the Australian Government, Coles, Bunnings, Inghams and Kmart. You will also notice the fund does not have more than 11% income exposure across any one tenant, providing beneficial diversification of income. The fund has delivered a strong 11.2 total return since inception and pays distribution on a quarterly basis. The fund has benefited from the strong industrial market fundamentals that continue to play out across the sector. The Charter Hall Direct Long WALE Fund, or LWF, is our diversified fund, also open for investment. LWF provides investors with a diversified exposure to various property sectors. The fund has a portfolio of $596 million with a focus on resilient sectors across office, industrial and logistics, long WALE, convenience retail and social infrastructure. The fund's top 5 tenants comprise of close to 60% of the fund's overall income, benefiting from both federal and state government, Bunnings and Coles. The fund also benefits from a strong 8.9-year weighted average lease expiry profile, 99% occupancy, and has provided investors a 10.1% total investment return since the fund's inception. The fund also pays distributions on a monthly basis. LWF has its major liquidity event approaching. Management will be writing to investors at the end of May, providing details of the liquidity event, whereby investors can decide on their future investment within the fund. The fund does continue, and as we know, the majority of investors will remain invested within the fund. The Wholesale Property Series number 2, or WPS2, is also open for investment. This fund is a little bit different to our other funds, as it's only open to sophisticated investors defined by the Corporations Act. The fund provides investors a long weighted average lease expiry profile of 12 years and high occupancy of 99%. WPS2 provides investors exposure to a high quality tenant customer profile, with the top 5 tenants comprising 60% of the overall fund's income. This includes household names like Telstra, Bunnings, David Jones and Coles. The fund provides investors exposure to a diversified sector and allocation across core asset classes, including industrial, office, long WALE retail and social infrastructure, as well as a small allocation to listed AREITs. This provides access to some of Charter Hall's highest quality wholesale funds and partnerships. The next allotment date for WPS2 is 1 June and has a minimum investment of $250,000. If you are interested in this fund, I encourage you to read the information memorandum or consult your financial planner to understand the risks and structure, as this fund is a little bit different to our other direct funds. The next fund is our Maxim Property Securities Fund. This is a fund that invests in stocks traded on the ASX. So, in line with recent Australian equity market performance, unfortunately, the 12 months ending 31 March, Maxim delivered a total return of negative 17.5%. This is slightly below the fund's benchmark of negative 14%. However, over the long 10-year term, the fund has delivered solid performance, returning 9% and is above the benchmark of 8%. The fund maintains high conviction and an active management approach. The prospects for the sector are positive given the strong demand for industrial and logistics, the return to work in the office sector and more visitation increasing, as well as the sizable share price discounts currently on offer in the underlying asset values. Finishing up, I will now cover off on the fixed life funds. These funds are closed for investment across BW Trust, Div3 and WPS1. BW's next liquidity event is in Q1 2024. The fund has provided investors a 4.3 total return to 31 March 2023. Div3's liquidity event is not until the second half of 2024, and the fund provides investors 100% occupancy with a weighted average lease expiry profile of 10.9 years. WPS1 has provided investors a 12-month total return of 9% and also provides investors exposure to a portfolio of over 270 assets and is in its 3-year investment period. This now brings me to the Q&A part of the presentation. First question that received is, why is the distribution rate not increasing despite rental increases? Well, we undertake a continual review of our fund distributions, and we do seek to increase distributions where there is an opportunity. Despite the market rental growth that we're seeing across the property sectors, particularly in industrial and logistics, we have seen this offset by rising interest rates and cost of funding. Despite a level of interest rates partially fixed within the funds, the impact of increasing interest rates increase the interest cost for the funds and in turn can impact the fund's overall income. In June 2023, the management team will be working with the responsible entity board to finalise the fund level budgets and review the distribution rates for financial year 2024. The next question is around PFA's 12-month return. PFA returned 2.6% investment return over the 12 months to 31 March. Historically, PFA has averaged higher returns over the 12-month period. Your quarterly report mentions the high-quality portfolio of PFA. Can you please explain the 2.6% total return? Thank you. This is a really good question. The first thing I'll highlight is that the benchmark is the MSCI Wholesale Fund Index. The benchmark comprises a diversified mix of properties across office, industrial and logistics, and the retail sector. So yes, PFA did underperform when you look at the entire benchmark. However, if you do look at the office sector specifically, the 12-month benchmark was only 2.3%. So PFA did outperform when looking at the office sector specifically. However, we can't pick and choose benchmarks at Charter Hall, and we do look at the Wholesale Diversified Property Index. Well, that concludes our update for the March quarter. Thank you for joining me today. I hope you gained some valuable insights into our funds and the Australian commercial property market. If you have any questions on something you've heard today or anything else, please get in contact with our team who will be more than happy to assist. Thank you.